$10,000 sits in your account, and for the first time, your bank starts calling you differently. Not a customer, a client. Nobody explains why. No email, no warning. Just a quiet shift in how the machine looks at you. Because somewhere around that number, you stop being a saver. You become a decision. This is the moment nobody talks about. Not because it's a secret, because it's boring to explain and expensive to ignore. Here's the truth. Financial systems are built in tiers, not by law, by behavior. Under $10,000, most people are surviving. Paycheck in, bills out, repeat. The system doesn't need to work hard to keep you there. Convenience fees, low interest, checking. A debit card that quietly does nothing for you. It's not a trap. It's just neutral ground. But cross 10,000 and something changes. Not in you, in the incentives around you. Suddenly, the same banks that ignored you start offering wealth management. The same apps that showed you a savings rate of 0.5% now whisper about exclusive investment opportunities. Robo-advisors recalibrate their pitch. Credit card companies raise your limit without asking. It feels like promotion. It's actually positioning. Because at $10,000, you are no longer a liability to the system. You are a potential revenue stream. Let's rewind for a second because this matters. Money doesn't sit still. It's never just saved. It's always working for someone. When you keep $200 in a checking account, no one cares. The amount is too small to route anywhere profitable. But once your balance crosses a threshold, banks can lend it out, invest it, package it into products that generate yield elsewhere. You become part of their balance sheet strategy, not because you did anything, because your number changed. This is the quiet upgrade, not you leveling up. The system leveling up its interest in you. And here's where the math gets uncomfortable. Financial institutions don't profit from people who are broke. They profit from people who are almost stable, the ones with just enough to be tempted into products slightly beyond their needs. A high-yield savings account with hidden withdrawal penalties. A credit card with rewards that only make sense if you overspend. An investment app that nudges you toward premium tiers the moment your balance crosses a visible milestone. $10,000 is exactly that milestone. Psychologically round. Financially strategic. You feel safer. The system sees opportunity. This is where the hype versus reality gap opens wide. The hype says, once you save $10,000, you're ready to invest aggressively, diversify into 5 different assets, maybe even explore real estate or business funding. Financial influencers love this number. It sounds like a starting line. The reality is messier. $10,000 is not freedom. It's leverage, and leverage cuts both ways. If you don't understand fees, one managed investment account can quietly eat 1 to 2% annually. That sounds small. Compounded over 20 years, it can erase tens of thousands of dollars in potential growth, not because the market failed you, because you paid rent to access it. Meanwhile, credit systems recalibrate too. Once your balance crosses that same threshold, your risk profile changes in lending algorithms. Loan offers appear that weren't available before. Interest rates shift. Some improve. Some are dressed up to look better than they are. The bank isn't lying. It's just betting that a person with visible savings is more likely to take a risk they can't fully calculate. This is the irony most people miss. The very moment you start feeling financially secure is often the moment financial products get more aggressive. Not less. It's not a conspiracy. It's incentive design. Systems evolve to extract value wherever value becomes visible, and $10,000 sitting quietly in an account is visible. Now zoom out. This isn't just about your bank account. It's about how modern financial infrastructure treats thresholds as behavioral triggers. Credit scores shift meaningfully around certain balances. Marketing algorithms retarget users differently. Once spending patterns suggest disposable income. Even social platforms adjust the type of financial ads you see. Once your digital footprint implies stability, you didn't apply for any of this. You just crossed a number. And this is the part that should make you pause, not panic. Financial upgrades are not always about opportunity. Sometimes they're about exposure. The more visible your money becomes, the more systems are designed to move it, guide it, or borrow against it. Not maliciously, structurally, because idle money threatens the very systems built to circulate it. Think about that. An economy doesn't grow from money that sits still. It grows from money that moves. So the moment yours becomes large enough to move meaningfully, everyone from banks to fintech apps to advisors has a reason to help it move in a direction that benefits them first, and you second. This is why financial literacy stops being optional right around this stage. Not because the poor don't need it. They need it desperately. But because at $10,000, ignorance becomes expensive in a new way. Before this point, mistakes cost you convenience. After this point, mistakes cost you compounding. And compounding doesn't forgive slowly. It forgives never. Here's the uncomfortable question worth sitting with. If crossing $10,000 quietly changes how banks, algorithms, and advisors treat you, what other invisible thresholds are shaping your financial life right now without your permission or your awareness? 50,000. 100,000. The moment your credit utilization crosses an unseen percentage, the moment your spending pattern flags you as premium. Each of these lines exists. Each one changes the game slightly, and almost none of them are ever explained to you directly. You don't get a notification saying, "Congratulations, you are now more profitable to target." You just start noticing the offers get sheenier. So maybe the real financial upgrade isn't the number in your account. Maybe it's realizing that every number triggers a system reaction you were never taught to see. And once you see it, you can't really unsee it again. The question is no longer how much you have saved. It's who's been quietly watching that number rise and what they plan to do next.